Hi, I'm Norm Wright with SKC Financial Group. In this video, we look at the most important market and economic events from May. We will cover three main topics: stock prices reaching new record levels, interest rates moving higher, and a new leader taking charge at the Federal Reserve. The Federal Reserve, often called the Fed, is the central bank of the United States. It plays a major role in managing interest rates and keeping the economy stable. May was a positive month for investors overall. Stock prices climbed to new records, though the bond market faced some challenges due to concerns about inflation and higher long-term interest rates. Bonds are loans that investors make to governments or companies, and they receive regular interest payments in return. On top of all this, the Fed got its first new leader since 2018. There is plenty to discuss, so let us get started. Let us begin with interest rates, which were a major story throughout May. The interest rate on 30-year U.S. Treasury bonds, which are long-term loans to the U.S. government, climbed to its highest point in nearly 20 years. During mid-May, it briefly reached 5.18% before pulling back to just below 5% by the end of the month. This rise was mainly driven by inflation, coming in higher than expected. Both consumer prices, which measure what everyday shoppers pay, and producer prices, which measure what businesses pay, rose more than anticipated. Energy costs were a big part of that increase. When inflation rises, interest rates tend to follow. This is because investors want to be paid more when the purchasing power of each dollar is shrinking over time. For everyday consumers, higher rates means that mortgages and personal loans become more expensive. For businesses, it costs more to borrow money to run and expand their operations. There is a positive side to this, though. When interest rates are higher, bonds pay out more income to investors. This can be a real advantage for well-rounded investment portfolios. It is also worth remembering that interest rates have been hard to predict in recent years, and they are still far below the levels that many people feared when inflation was at its worst. Tensions in Iran continue to develop, and oil prices have come down somewhat, which helped rates ease a bit toward the end of May. Even with the pressure that rising rates puts on bonds, the stock market pushed to new record highs. In fact, the S&P 500, which tracks 500 of the largest U.S. companies and is a broad measure of the U.S. stock market, reached 22 new all-time highs this year through the end of May. This strong performance has also stirred excitement around upcoming initial public offerings, or IPOs. An IPO is when a private company sells shares to the public for the first time. While many investors pay close attention to how a stock performs right after its IPO, the bigger picture for long-term investors is that more IPOs means more choices when building a portfolio. Thinking about large technology companies today, it was not the IPO itself that created the most wealth for investors, but the growth those companies delivered over the years and decades that followed. As this chart shows, the S&P 500 price to earnings ratio, which compares the price of stocks to the profits companies are making, is currently around 20.9. This number sits comfortably within the range seen in recent years. It reflects the fact that strong growth in company profits has helped keep stock prices from looking too expensive, even as prices have risen. That said, stock valuations are still well above their long-term historical averages. This does not predict what will happen to markets in the short term, but it is worth keeping in mind when thinking about how a portfolio is structured over the long run. Spreading investments across different sectors, company sizes, and investment styles can help manage risk while still allowing investors to benefit from market growth. Finally, let us talk about the change in leadership at the Federal Reserve. In May, Kevin Warsh was sworn in as the new Fed chair, taking over from Jerome Powell. Warsh is not a new face in financial circles. He previously served on the Fed's Board of Governors during the 2008 financial crisis, which gives markets a sense of who he is and how he thinks. Warsh is considered someone who wants to reshape how the Fed operates and has indicated he prefers a central bank with a sharper, more defined focus. Changes in Fed leadership do not happen often, and when they do, they naturally raise questions about where interest rate policy is headed. The environment Warsh is stepping into is a complex one. The broader economy is in reasonably good shape, but inflation has been picking up in recent months, and the job market has sent mixed signals. For investors with a long-term view, history provides some comfort here. Across many different Fed chairs and a wide range of political and economic conditions, the economy has continued to grow over time. A new Fed leader can create some short-term uncertainty, but these transitions rarely alter the deeper forces that drive economic growth. We hope you found these insights helpful. If you would like to learn more about any of these topics, please don't hesitate to reach out. We look forward to speaking with you.